Tonight, for the first time in this show's 9-year history, this is a pension special. And I want to start by scaring the pants off you. I'm often asked how much you should save towards your old age. So let me give you the rough rule of thumb. And to help, I'd like to introduce you to 3 celebrities. There we go, Dina Asher-Smith. I'm a big athletics fan, and Rochelle Hume and Ben Shepherd over there. I have no idea whether they have pensions or not. But this is the key. The rule of thumb is to get roughly 2/3 of your final salary each year in retirement, you'd need to take the age you start contributing to your pension, halve it, and put that percentage of your salary in for the rest of your life. So Dina's 25, half that, Angelica?
12.5.
Very quick. Yep, 12.5% for the rest of her life. Rochelle's 31 if she were to start now.
15.5.
15.5% for the rest of her life. Ben Shepherd's at least 60, half of 60.
23.
No, 30, half of 60 is 30. Sorry, Ben, it's a friend of mine. He's too pretty for his own good.
Don't be mean.
Look, I know what you're thinking. You're doing that equation for yourself and you're saying, there is absolutely no way I could afford that. And you're right. Very few people do. But the real message I want you to get out of that is the earlier you start contributing to your pension, the better. The less of your salary you have to put in. If you know a 20, 21-year-old, tell them get money in your pension now, even £10 or £20 a month, because it's got time to compound, and that'll make you a much better retirement.
No, I like that, but what else have you got coming up on the pension path?
Oh, well, we've got lots. Tonight, I hope to get through where's the best place to get a private pension. Also, should you opt out of auto-enrolment? Plus, the massive tax trap. If you take money out of a pension the wrong way, could cost you tens of thousands of pounds. And I'll tell you how long you're likely to live, because that matters here too.
Okay, here's a question, though. You know, you're saying after 9 years you've never done a pension show. Why now?
Well, because it's a regulated subject and our previous format didn't fit it. But now, because we're live, I can have 2 special guests with me who are pension specialists who can answer the questions I can't answer. Thank you for joining us, by the way, folks. So if you've got questions, get them to them.
That's right. Any questions on pensions, please send them in for now or future shows. Get in touch, email at martinlewis@itv.com or tweet using the hashtag Martin Lewis. Now, we are dedicating the whole show to pensions, like we said. But before we get to that, last week's show was all about banking, and we've had this success in that I'll tell you about from Jordan Forbes. Look, he's bought us both a drink already. I love that. He managed to get around £2,000 back on packaged bank accounts. Result?
Well, that's very quick, but not unusually quick for packaged bank accounts. Those are the accounts, remember, where you pay a monthly fee, 10 or 15 quid, to get added insurance, very commonly missold, so you can reclaim them. Don't pay anyone to do it. There's free tools online to help you reclaim. It can be big money. I also mentioned last week, I talked about 2 bank accounts that paid you to switch to them. I said I thought a third had launched. It has launched. It's First Direct. It pays £100 if you switch to it, and it's one of the top-rated banks for customer service. You've still got HSBC giving 125 quid. Virgin Money's dropped its wine. It's now about 140 quid's worth of wine, but it is now giving money to charity as well. So if you want to switch your bank account, it's still a good time to do it.
So you were right?
Hey, always.
He's always right. He's always right. OK, back to pensions. Let's start with a quick recap and really break things down. From our Teenagers Financial Education Special in September, this is great. What is a pension?
On average, people in the UK live until around age 85. Yet typically they only work and earn for 45 of those years. Of course, for the first 20-odd years, it's our parents or guardians paying for us. But then, you'll probably have to do the same for your children, so it all evens out. For the last 20 years of your life, you're generally retired and not working, so need money to live off, and that's where a pension comes in. What's commonly referred to as a pension is often a payment made regularly to you in later life. There are 2 types. The state pension, which aims to provide a minimum standard of living, is paid out via the government. Then there are private pensions, which you save for yourself or with your employer. And private pensions have a saving superpower. Normally, when you work, for each £100 you're paid, tax is taken off. So most people only actually receive £80 in their pocket. With pensions, you can save the money before the tax is taken off. So you get to put away £100 and it only really costs you £80. You rarely get that elsewhere. Pension money is invested in the stock market, property, government bonds and more. The younger you start, the better, as that means they've more time to grow. You can't take it out until you're 55, but still start it when you're young, or you may end up with a cold-baked bean retirement.
Just love that film, nice and clear. But it's all about company and private pensions tonight. That's what we're sticking with.
Yeah, we can't do the state pension as well. It's just too much information. Hopefully that sets the theme, and I want to get into the nitty-gritty too. OK, let's go to the first part of the big briefing. So let's start with the different types of pension. First question, do you have a company pension? That's often the best way for you to put money in, as they may contribute too. Now, these fall into two different camps. The old gold standard, less of them available now, are final salary schemes, where you get a set percentage of usually your final salary each year in your retirement. So, for example, you get a 60th per year. So if you work there 20 years, you get a third of your final salary in retirement. These days, though, most new schemes are money purchase schemes. And this is both workplace schemes. This is also how all private pensions you set up yourself work too. And this is where you build up a pot of investment and savings with a pension firm. The size of the pot depends on how much you put in and how well the investment performs. And then, from age 55, you can access the money, and we'll be talking about that in the second half. Now, one big warning, if you ever get someone, hello, would you like to access your pension? You're 48, I can get the money out for you. Don't do it. They're scammers. Don't touch them. You shouldn't be getting cold calls about taking your pension money out before 55. And in fact, even after that, I'd be very careful of cold calls too. Let me move on. Now, auto-enrolment is a big change over the last 5 or 10 years. What this means is, if you're an employee, you are almost, in most cases, automatically saving into a pension without having to make a decision to do it. It's done for you. This happens to those aged 22 or over who earn more than 10 grand a year. Now, the contribution is a minimum 8% of your earnings, but at least 3% of that has to come from your employer. So they're giving you extra money they wouldn't otherwise be giving you. If you earn under £10,000, by the way, or you're under 22, you're not automatically opted in, but you can choose to opt in. Provided you earn just over £6,000 and you're at least 16 years old, then if you opt in, your employer must contribute. So I would actually suggest you do strongly consider that. And the maths is why this works. Let's look here. Let's take a basic 20% taxpayer. Say you contribute £100 a month. On the 3% basis I talked about before, your employer would add 60 quid, which means you've got £160 a month going into your savings. And as I explained in the film, though, for you to contribute £100 a month, you don't pay that because that's before tax. The cost to you in your pay packet is 80 quid a month. So you are paying £80 a month in effect, and you're getting £160 a month saved. High rate taxpayers, it's even better. It costs you 60 quid to save £160. So don't opt out unless you absolutely have to. You are giving up voluntarily a pay rise if you opt out. Yes, I understand it reduces your take-home pay, but the benefit for later in life is absolutely crucial.
Now, at this point, I think we should go to Kim, who is one of our viewers, who lives in North Lincolnshire. Hi, Kim. You're self-employed, aren't you?
I am, yes.
What's your question, Kim?
It's as I'm self-employed driving instructor, as of yet, I do not have a pension. What's the best one to go for? I'm 35 at the moment.
Are you a sole trader or a limited company?
I'm neither. I'm just self-employed.
Sole trader. You're a sole trader then. So let's go over to David over here, who's a pension advisor. David, my assumption would be someone starting off, the simplest form of pension is a stakeholder pension that has limited charges. The two big ones are Aviva and Standard Life. Is that where you'd be going on this?
Absolutely. It depends on how complicated she also wants to make it as well. So a stakeholder is a great place to start. Low cost, low charging, easy, simple. You can go to a personal pension, you can go and see financial advisors and get advice. Or she could go, if she wanted to, full fat and have a SIP if she maybe wanted to put her property or an office that she's got for her driving instructor school into it.
So basic is a stakeholder pension. If you've got more money, you might go for a personal pension plan through an advisor, but you'd pay for it. What type of level of contributions would you need to be starting to want to pay for advice like that?
It varies, really, but I would say once you're starting to look beyond having a stakeholder pension and paying about £3,600 a year in, it might be worth looking at that and getting some more detailed advice and investing in some proper funds.
Kim, how much are you looking to save away, roughly?
As much as possible. At the moment, because obviously with COVID, I'm not currently working, so it's it's basically unknown how much I'm going to get every month, really, being self-employed.
So the simple route is a stakeholder. If you've got much bigger contributions, you'd probably want to pay for an advisor. If you were very sophisticated, and the fact you're answering this question probably means your finances aren't that complicated, then you'd look at a self-invested personal pension where you can control your own investments. Now, just before we get on, you're from the Pensions Advisory Service, which is a government agency. You're a pensions advisor.
Yes.
When would I come to you, Kaya?
Guidance, I mean, there's a number of different reasons why you may want to seek guidance, but really it's just to get more knowledge, feel more informed and be more confident, and hopefully you can then make an informed decision. You may still want to seek financial advice to get a personal recommendation, so it really depends on your circumstances.
So the free service of the Pension Advisory Service is if you want guidance and to understand how things work and ask generic questions, where you go to a pension advisor if you want help picking an actual product, if you had sort of a more complicated pension option out there.
Exactly.
Thank you for the question there. Let me just ask you some more we've had in. Linda emailed, and we get very common this, pension consolidation. I've 4 work pensions with different employers, which I'd like to consolidate into one. Should I do it, and what's the best way? David, this is one for you, I think.
She can indeed consolidate them if she wants to, but what she's got to be careful of is losing out on something that she might have hardwired into those existing contracts. Because once you move them, you can't get out of it. So guarantee annuity rates might be good on there. She might have higher than 25% tax-free cash. So you have to be really, really careful. Compare all that she's got, charge the fees, look at the costs, and decide what she actually wants to do. But just be careful before you move them.
And an independent pensions advisor would be able to help you with that if you need it, or you can look through the charges yourself. Francis, should we start an AVC, an additional voluntary contribution? So that's for a company pension where you want to pay more. Is it a good idea?
Yes, definitely. The more you can pay into pensions, Martin, the better off that you're going to be in your retirement. But what she needs to watch, though, with an AVC, it'll be linked to a company pension scheme.
Yep.
So it could be one of the final salary ones that we were talking about earlier. So in which case, what she might want to do is to look at something called added years before she looks at an AVC, just to make sure that option isn't available to her before she commits to doing something else.
And I presume her employer will be able to do the calculation whether she's better to do an AVC or to pay for added years later
Absolutely.
on. And then we've got this one from Linda P. My 16-year-old will start earning minimum wage with a football scholarship in July. No pension is included. Should he start a pension at 16? I'm going to answer this one. On the graphic earlier, I said, if you're earning over £6,000 and you're age 16, if you voluntarily opt in to auto-enrolment, your employer has to contribute. So if he's going to be earning that much, he's 16, well, make the employer add on top. Nothing's going to beat that, is it?
Absolutely not.
No.
Jelly.
Lovely. OK, time for a break now. When we come back, a major warning about a pension tax trap that can cost you tens of thousands of pounds, plus more of your intuitive questions. We'll see you in 4. Welcome back. Thank you so much for all your messages. We've had an overwhelming number of questions on pensions. I'm going to go straight to William Martin for you. This is with a private pension. If you die before your retirement, can your spouse or children claim your pension?
We're just discussing that, weren't we? If it's a private pension, yes, you can absolutely leave your pot of money to your dependents. If you die under 75, it's tax-free. Over 75, it's taxed at their income tax rate. It's more complicated on final salary pensions, though.
And this one from Smashing Iron. Do you think...
Did I get that right? Yes. Good.
You're doing well tonight, don't worry. Do you think investing in property is better than having a pension given the current state of the market?
I actually don't think the question works as people think. Property is an asset class. Pension is a tax wrapper. There are many types of property you can invest in your pension tax-free. Property investment type schemes. You can't buy your own house in a pension. So if you're just talking about investing in property, you could do it within a pension. It's not an either-or type question.
OK. Well, we've had part 1 of the big briefing. Time for part 2.
OK, so this is about taking your pension. And one of the most important considerations is how long will you live? Once you've hit age 55, pension freedom means you can use the cash you've got saved up. Now, when this first happened, the big sort of newspaper worry was people are going to buy Ferraris and have no money for the rest of their life. My concern was actually the opposite. I think we're quite risk-averse as a nation, so people would be living very low standards of living so that they can make sure they're eking out enough cash to last for the rest of their life when they could actually have a better life. So one of the things that you need to do, you should try and find balance, is think about how long you're likely to live. Now, obviously, your health, your genetics, whether you smoke, all have an impact. as does your age. The older you are, let's say you're 65, well, you've got rid of the risk of dying before 65, which actually means you'll live slightly longer. So that's the stats we'll look at. For someone aged 65 now, a man will live on average 20 more years to age 85. A woman is always about 2 years longer than that. And he's got a 25%, 1 in 4 chance of living 27 years to age 92, and a 3% chance of living to 100. A woman has a 5% chance. Now, I would say, actually, for me, that 25% level is a pretty good rough rule of thumb. If you were to think, I'm going to live around 27 years, unless you've got specific health conditions, and try and plan your finances that way, if you've got look like you're going to live longer later on, you might need to go a little bit more frugal later on. I think that's probably a pretty good rough rule of thumb for how long people are going to live once they get to 65, or 2 years longer for a woman, of course. The next big issue is tax. You can leave your money invested in your pension pot. Then when you take it out, a quarter of it is tax-free, and 3/4 is taxed at your marginal rate. In other words, the highest rate of income tax you're paying at that time. Now, here's the issue. If you take your money out of your pension, whether you take it all or you take it in bits, you can't say, I want the 25% tax-free now and I'll take the rest later. I use a Swiss roll as an analogy. You can have a slice. The jam is tax-free. A quarter of it is tax-free. 3/4 of it is taxed. And you have to have both. Now, the problem with that, let's say you're taking 20 grand out and you're a basic rate taxpayer. The 3/4 of that that's taxed gets added on top. That could push you into the higher rate tax bracket. So you're paying thousands of pounds of tax that you needn't do, because there is an alternative route. If you can take your whole 25% tax-free lump sum, if you put the rest in income drawdown, which is an investment product you can take money out of when you need, or an annuity, which pays you a set income each year for the rest of your life. Now, the reason this is important is it splits up the jam, the tax-free, from the sponge that's taxed. I'm pushing the analogy, but go with me. And this is the reason that counts. Let's say you're a higher rate taxpayer right now. If you were to use this system, take the money out, you'd be paying 40% tax on all the taxed amount. But later on in your life, you might drop down to a basic rate taxpayer because you're earning less. So using this, you take the 25% now and you wait to take the taxed amount until you're a lower taxpayer, so it's more tax efficient, you're paying less tax on the sponge. Now, I know this is complicated and some of you will be going, I can't cope. Don't worry, because one good thing about pensions is there's free help available. The Pensions Advisory Service.org.uk is an arm's-length government agency that can give you one-on-one advice. You can call them up, you can go on the web chat, and tonight, because Kaya is from there, their web chat, they've stayed open until 10 o'clock tonight, so you can get online if you want to ask them a question. If you don't get that, talk to somebody one-on-one about it.
Now, we've had lots of questions in on how to use your pension, like this one from John. I have over £90,000 in my pensions pot. Should I buy an annuity or do a drawdown? Well,
I'd say that was a $1 million question, but it's the £90,000 question. Kaya, annuity or drawdown?
It's a question that we do get asked a lot, Martin, as you can imagine. And really, it's always going to come down to someone's individual circumstances and requirements. With the annuity, they can get guaranteed income for life, it's secure. With drawdown, it's more flexible, but they could run out of money if the investment doesn't perform very well or they draw it down too quickly. They do have other options available to them. They can book in their free appointment with PensionWise to understand all of their options.
Yeah, I mean, annuity rates are appalling at the moment because interest rates are so low. I would express it like this. Annuity is a bit like a fixed-rate mortgage. You know what you're going to get, but the rate might not be very good. Drawdown is variable. You can hope it's going to perform better for you, but it may go wrong. Without a crystal ball, you won't know which one wins, I'm afraid. Let's go on to Ryan now. He said, due to low interest rates, I have a lump sum I'd like to pay into my pension to get tax relief. Do I have to fill in a self-assessment form, or will an HMRC just let me inform them of a one-off?
Tax relief, how it works, it depends on the type of pension that you're paying into. If he's paying into a money purchase scheme, it would automatically add in 20% tax relief, regardless of what tax he's paying. But if he's a higher rate or additional rate taxpayer, he would then need to claim that additional tax relief through his self-assessment. So
probably no self-assessment if he's a basic rate taxpayer, putting it into a pension pot, but there is if he's a higher rate taxpayer.
Yes.
And then probably one for David this. Catherine emailed, is there a risk-free way of saving a few thousand per year in a SIP scheme? Well, you can actually have almost savings-type funds in a SIP, can't you?
Yeah, you can invest in cash in bank and building society accounts within a SIP. My question probably would be to her, though, is why would you be paying for a SIP? Because you'd be probably paying higher charges that you would need to have if all you want to access is cash. You might find lower risk investments in things like stakeholders or even in personal pensions. So just watch the costs.
And I normally talk about savings, but when it comes to your pension, you're investing over such a long period in most cases, you would hope that actually putting it in the markets would outperform savings, and some risk is useful. You know, even government agencies would say, yeah, you're going to be looking at some form of risk to try and hope it will go quicker. Risk isn't bad. Risk just means hopefully it's going to grow quick, but there's a chance it may not. Last quick question. Andrew, Kai, for you. I'm 45 years old. Is it too late for me to start looking at a pension? Well, 45, absolutely not. But I'm going to tweak his question, because 45, no, you're fine. If he was 63, is there a risk by putting money in a pension if he's not got any other savings he could lose pension credit? State pension's fine, but pension credit?
It is possible because pension credit is means tested, so it could impact eligibility, but then there's also benefits of saving into the pension, so it really could depend.
Andrew, at 45 you were fine. At 63 we might give you a different answer. Thank you both so much, guys. Absolutely brilliant. And remember, free advice is available. If you've got more money, go to an advisor and you should be working.
So informative. Listen, quick update. Last week, Martin politely invited the Chancellor onto the show after the budget on the 3rd of March. Social media went mad. We had so many messages, including this one from Zoe. She says, please consider, Rishi, please consider talking to Martin. You're both problem solvers at the end of the day, striving for a solution. You both are great at explaining things in an accessible way. Things can be fixed. Do you think he'll come on?
I hope so. He hasn't said yes yet. Chancellor, we get 3 million viewers, biggest current affairs show on telly. We'd love to put real people's questions to you. That's it for this week. Next week, it's our 100th edition, so it's Ask Me Anything, and also they're probably going to show some embarrassing clips of me in the first programme, that type of stuff. Get in touch.
There's
Bye-bye.
loads of those clips, loads of those. Oh.